Hello, and welcome to CFI's Financial Inclusion Week. I am Julia Arnold, gender lead here at CFI. CFI is an independent think tank housed at Axion, where we engage and challenge the industry to better serve, protect, and empower clients through research and advocacy. As part of our work on women's financial inclusion, CFI is leading research to uncover key normative constraints impacting providers and limiting women from improving their lives through financial services. Social and gender norms are the rules and behavior that determine social behavior, expectations, and conduct. They are typically informal rules that determine actions, perceptions, and expectations at the individual, household, and community level, influencing household roles, livelihood responsibilities, and public life. The hope is that evidence built at CFI will catalyze knowledge, innovation, and initiatives to embed norms transformative work throughout the inclusive finance field. We are delighted to host this conversation today with three brilliant speakers. Supriya Garikipati is an associate professor in development economics at the University of Liverpool, UK. Dr. Jemima Njuki is a senior program specialist and coordinator of the Growth and Economic Opportunities for Women program at Canada's International Development Research Centre. And finally, Leora Clapper is a lead economist in the finance and private sector research team of the Development Research Group at the World Bank. We invited Supriya, Jemima, and Leora to discuss the role social norms play in women's financial inclusion. Let's begin. To start, I want to answer the most basic question first. Why should anyone care about social norms in financial inclusion? What do they have to do with financial inclusion? And how do you approach social norms in financial inclusion in your work and research?
So if you look at the fintechs data, which is data based on surveys with over 150,000 adults in over 145 countries, women have a long way to go. So the trends in fintechs data, they demonstrate growth in women's account ownership, but there's still a significant gender gap, which has persisted since 2011. So since 2011, over 600 million women have opened an account. Yet in developing countries, on average, men are still 9 percentage points more likely than women to have an account. And that gap has been unchanged. And what's important also is when you look at the relationship between account ownership or the gender gap, and for example, GDP per capita, economic development, it's not very strong. The relationship in developing countries isn't significant. And that's where other things kick in. So what we're saying is that, yes, as countries get richer, more women get accounts, but among developing countries, there's tremendous variation. And that's where things like social norms, regulatory policy matter.
I mean, I wanted to sort of reflect more on how I use social norms in my research work. Social norms are quite central to the work that I do, as they should probably be to anyone working in the area of financial inclusion. Even from the start, where I think about how to frame the questionnaire, right up till the data analysis, social norms play a very big role. Having a really good understanding of what the norms are locally, doing your homework, if you like, is really useful, because otherwise you could fall into the danger of missing out crucial information, and you could end up with the results that are either incorrect or completely misleading. So to give you an example from one of our field studies, we had this project where we wanted to understand how women use their loans, how women use their microcredit loans. So one year we went and asked women how they use their loans. And one woman particularly stood out in our work. She was extremely adamant that a woman's role is within her household, and that she herself was better off giving her loan to her husband for him to use in a way that he deemed appropriate. A year later, 12 months later, we asked the same households how they were getting on with their loans. And this woman was excitedly telling us about how she used to further her vegetable business. So we could have just moved on, and we would have moved on had we not thought about, something quite interesting is happening here, and perhaps this has got to do with social norms. And we went back and asked her to explain the inconsistency in her answers, obviously putting it nicer than that. And she explained to us that last year her mother-in-law was alive, and that she had to say that because that was what was expected of her. But now that the mother-in-law is no more, she can now finally start to do what she really wants. So I think if we did not think about, going back, because there was something, inconsistent there, perhaps social norms had something to do with it, we could have moved on without actually understanding what this woman's real preference for her loan was. So yes, in my work, social norms do play a very central role. I mainly work in India with a focus on credit for rural women. So for that particular context, if I had to use just one word to describe these constraints, then that would be patriarchy. So we need a fuller understanding of the kind of negative culture that patriarchy produces. And it most severely impinges on how women's time use is viewed. So patriarchy has got a lot to do on producing this negative culture, on dictating how women are meant to use their times. It also impinges on social attitudes, controls behavior, and creates a certain expectation that everybody sort of needs to satisfy. And that's how we view norms as. And I think it's important to have an understanding of these norms, because otherwise you could go in and get completely different results if you don't.
Fantastic, Supriya. Jemima, how are social norms, how do they interplay with the work that you lead at IDRC?
If you look at norms as these, accepted standards of behavior, of social groups, what people are expected, how people are expected to behave, as social norms as defining who can do what and who can, own what, who can do what, and who cannot do what. You start seeing how much it then is intertwined with financial inclusion. And there is also, we need to also understand that there is conformity to social norms. And just like the example that Supriya has given about women wanting to conform to what is expected of them, how they're expected to behave, what they're expected to do. And so social norms are also a big predictor of what people say and what people do. And in this sense, our starting point for our research on social norms and financial inclusion has started from the perspective that financial inclusion can be transformative, but it may not be transformative depending on the context in which this financial inclusion is happening or is applied. So we've been looking at this research from two perspectives, looking at women themselves and the context in which they live, the relationships that they have to interact with on a daily basis, whether those are spousal relationships, whether they are familial relationships with mothers-in-laws and fathers-in-law, whether they are community relationships in terms of how does the community then perceive them. And even their own agency and how social norms define how they can use their agency or not use their agency, how social norms determine their own aspirations. So looking at that side of the coin, but also looking at the supply side of financial inclusion and how people perceive the role of women in society. Because even when women have their own agency and aspirations and can get financial services in their own right, how the financial service providers themselves behave towards women, what they require of women, how they perceive women going into a bank to get a loan. Do they see a business person, or do they see a woman that they have to ask her husband's permission before they can serve that woman? When they're looking at what the financial needs of women are they taking into consideration that social context and actually working with women in a way that addresses that social? And some of our research has actually shown that even as financial inclusion has expanded for women, it hasn't always led to empowerment of women or better well-being for women. And a lot of that is explained by these social norms, the patriarchal system that limits them from actually doing what they need to do with that financial access. I'll just give you an example of some of our work in Zambia. Research showing that a lot of the women that were expanding their businesses were actually getting the initial capital to start their businesses from their families. And this is not their maternal families, but their husbands and the families of the husband. And therefore, when you look at their businesses, one of the questions was why are women not growing their businesses? But it's because their businesses were so much tied to the family setup that even getting a loan from the bank to expand their businesses depended on a lot of negotiation within the family. And therefore, very few of the women who had started their loans from their businesses from either a loan from the husband, from a family member, were actually expanding their businesses as a result of this. Just because even the major business decisions, because of the expectations that this is actually not a woman's business, but the business is by the husband and the family is invested in that business, the woman couldn't make decisions about expanding that business. So in fact, social norms is so intertwined. We say that addressing social norms is what's going to make financial inclusion transformative for women.
That was fantastic. Supriya, you brought up that example of the mother-in-law, and I'm wondering, how do we shift the mother-in-law attitude or the gatekeeper attitude while the mother-in-law still is alive?
So I work primarily, looking at what are the constraints, the demand side constraints, right? Which do those touch on the supply side challenges. So for example, right, so the question is why we know that's not build it and they will come. That you just can't offer financial services. The take-up by women is not the same as for men. And then the question is why, right? And what we are discovering that there are a lot of challenges to the use of financial services, which I would say are social norms. So for example, you think about the increase in governments digitizing social transfer payments. And we know that the research shows that that's good for the government. It's cheaper, it's more efficient, it might reduce corruption and leakage. And there's also evidence that's good for the recipient, the digitization. They have the option to get the money into an account. They can then potentially use that account. Also now in the time of COVID, it's more sanitary not to use cash or to have to stand online. And so we're seeing this rapid digitization of government transfer payments. But where we need to be really, really careful is the social context. So for example, you look in Bangladesh, for example, where most mobile phone agents are men. And a simple constraint to women withdrawing money themselves is not wanting to give their phone number to a strange man, which is necessary to activate their account and withdraw the money. This is a challenge that can be addressed by, just keeping track, measuring the number of the gender of the agent network, identifying the problem, B, incentivizing the hiring of female agents. Colleagues of mine are working a project with the large mobile money operator to understand how women can be encouraged to play more of a role. The second challenge are gender differences in financial experience, weak numeracy, literacy issues, which again make it more difficult for women to use the account themselves. The idea being if previously, let's say a program for mothers, the cash was handed to the woman where they have more control over that money, perhaps. If the money goes into an account and the woman needs male assistance withdrawing the money, she can really lose all control over the money. I would end by saying though, I've been doing a lot of work with garment factory workers in Bangladesh, for example, where we offered where for control continue to be paid their wages in cash, and a control group paid their wages directly into an account. And we see big benefits of being paid into an account. The woman's savings more than doubles. We see a tremendous amount of learning by doing, a woman being more financially capable, for example, to send remittances home themselves rather than using an agent. And we also heard, to continue the mother-in-law saga, women said to us, my mother-in-law waited for me outside the gate on payday, now she can't. That women are learning that having greater control over their money by keeping to an account is giving them greater empowerment in the home over economic decisions, financial decisions on how that money is spent.
I think let me pick up from where Laura has left off, because one of the things we need to also understand is that these power relations between men and women, within the family community system, they are actually complex. They are very multidimensional. They are pervasive. It's how people have lived for a long time, and so we also need to employ a diversity of tools and angles. And one of the first thing we did at IDRC was to really figure out and ask ourselves, what would a transformative way of doing financial inclusion look like? Because we have to start there. Otherwise, we also might have piecemeal interventions that still don't get us to the desired outcome. And we actually defined it, I remember so well, as a way of doing financial inclusion that creates gender equal financial systems that actually work for all, irrespective of their gender. It is financial inclusion that leads to the empowerment of women, that leads to changes in those relations, which means whether those relations are at home, whether those relations are within networks, whether those relations are between women themselves and financial institutions. And so that has been a very good starting point for us, because then it sort of defines what do we then need to work on. And the first thing is, as Laura has rightly said, it's working on women's agency and voice. That women are able to make decisions about their financial needs, the financial services that they need, and they're able to then make decisions about what to do with if they get a loan or if they get a payment, what to do with that payment. And that requires, I don't even like to call it training, because it's a reinforcement of women's agency and working with women so that they actually can articulate what these aspirations are and what their practical needs and realities are. But that then does not work if you do not deal with a mother-in-law. In this instance, does no work until you deal with the power dynamics that was talked about earlier of this patriarchal system. And so part of our approaches and gender transformative approaches has been working with that whole ecosystem. How do you engage men and boys for women's empowerment? How do you get to this understanding that women's control over income is a good thing for women themselves, for their families, for their communities? And it's part of the research we've been funding around how do you create community gender dialogues that actually start shifting how whole communities and societies start view women and view the relationships between men and women. It is a lot of intense work, but we believe it can actually lead to much more transformative and sustained change.
Thank you. Supriya?
One of the big issues I feel is with the way we expect transformation to happen, whether it is practitioners or academics, transformation is expected to happen at the individual level. If you can imagine the sort of ideal journey a woman makes, she gets credit Then she uses it to start her own work enterprise. She earns an income, starts paying for her children's education, and then suddenly starts having a say in household decision making. Transformation, unfortunately, does not happen in this linear way. And if in the odd case it does, that still remains an odd case. We are talking about transforming social attitudes. And this happens best when group solidarity is channeled. In our data, we observe clear externalities when women start a group venture. For example, social norms that do not allow a woman to sell in the marketplace or to return home after sundown. These social norms are relaxed when women come together in groups. This is because what a single woman may not be able to do, a group can. There is strength in numbers. It's as simple as that. In our work, we find that women defying market norms collectively, coming back to their village after sundown collectively. And this is happening, these margins that transformation is happening, transformation of social norms is taking place. I feel that the role of collective bargaining in actually achieving empowerment at the individual level needs to be better understood as a transformative approach. I think there's less, so empowerment is understood as an individual's achievement. We actually have less of an understanding of how it can be a collective achievement. The role of collective bargaining in individual empowerment is what is being missed out, really.
You know, how do we articulate the value proposition? You know, Jemima, you were saying that this is a lot of work to undertake from a financial service provider perspective, you know, understanding the norms and incorporating them into the products and services. I think one of the biggest questions is how do we make the case that this is worth the effort and time and frankly money for providers to really incorporate gender norms into their thinking. Another question is, you know, how are we measuring that change? How does that change come about? And Supriya, maybe you can speak specifically to the change that you're seeing from the group solidarity and what that looks like and how you are thinking about that shift.
Just expanding on the examples that I was just talking about, you know, when women are, we find clear differences. If a woman has started her own business, then the journey from credit to repayment looks very differently. And the likelihood that empowerment might happen along this journey is very, very low. However, when women start something together as a group and take advantage of the solidarity aspect of credit groups, then the results look very different. Expanding on the two examples that I was giving you earlier, this we found in villages in Andhra Pradesh. So the rules are very clear. You really need to be home. You need to be back home before the sun goes down, because that is seen as a social norm that cannot be broken. But when women actually break this social norm together, they do it very, very carefully. First of all, people are much more relaxed because women are in a group and they accept. Men strengthened social ties actually do play a big role in improving women's agency, both within the household as well as outside the household. So women being collectively present in the marketplace allows them to do things that a single woman could not have done. You cannot really accept a single woman in a marketplace, but collectively women are able to defy others who feel that they shouldn't be there. So, you know, they look out for each other. And there was one example in our fieldwork where women go collectively into a house where they know previous incidents of domestic violence and make sure that the woman coming late into the household has not got any issues. The family understands why she's late, and they linger around for a bit to make sure that she settles into the household back. And slowly, at the margins, social norms are being altered. And there is something about collective bargaining that, there's very little appreciation of, both within academia and perhaps within practitioners. But it would be interesting to hear what Laura and Jemima have to say about this. Certainly within academia, empowerment is seen as the journey that a single woman makes. It's an individual's achievement, or indeed individual's failure.
Mm-hmm. Great. Leora, would you be able to speak to the measurement?
I would add, changing social norms is really, really hard, which the other panelists are engaged with. I guess I've seen also other approaches in regard to at the same time working to change social norms, financial institutions designing products for women to enable them to use the products within the constraints of the social norms. For example, I've worked in Ghana. It was quite interesting. We had a mystery in the data that we kept seeing women who had bank accounts using these semi-formal, informal savings groups. So are actually really expensive. So for example, susus, where men would pick up $1 a day and bring it back at the end of the month, less a full day's savings. So we went to Ghana and asked women, why are you using these more expensive products? And it gave the obvious answer that they need to make these high frequency, low denomination payments. That these women were saying they couldn't keep $1 in their home overnight without their husband or family member borrowing or stealing the money. And that doesn't make sense to take a bus across town and wait online every day to deposit $1. Banks aren't designed for that purpose. And then what's really interesting was a few years later when we went back and we see in the data, a huge take-up of mobile money accounts by women. And what's been developed in Ghana and targeting women, is this ability to more conveniently and inexpensively deposit $1 a day at the local mobile agent, perhaps a merchant on her block, and keeping her money safe in a cheaper, more effective way. And not only that, a whole industry has developed, enabling these women to sweep their money from their mobile money account into a bank account, to build a credit history with that bank so they can potentially, access appropriate credit for their businesses. And so for financial service providers to develop products to address the challenges women might face in their homes.
It's interesting to hear you say that, there's an approach to design products and services to play within the constraints, the normative constraints. And then of course there's the idea of sort of upending the norms, the structure themselves, and creating a new system. And I wonder, at CFI, we're contemplating which of these, of course, it's not necessarily a choice, it's a spectrum, but gender aware versus gender transformative. What's the appropriate or feasible expectation, and what actually works best for women and their needs? Is total, systems change something that academics or those of us sitting in Washington, D.C. think is necessary, or can the sort of piecemeal, incremental activities within the existing system be enough?
And I think it's actually going to be a combination of both. But I think the fundamental issue here is, are we listening to women enough in terms of what they need and what they want and the change that they want? And so I hear Laura's example of how you can actually, financial inclusion service providers can actually design products that work for women within the constraints that they have. And I think we have seen a lot of that. The whole growth of microfinance was actually geared towards, if women do not have collateral to give to banks in order to get bank loans, what are the other alternatives to financial inclusion that exist for women? If as individual women, the constraints are much more amplified compared to actually using collective action, then what collective action mechanisms exist to actually create these pathways for women, while at the same time saying that some of these norms have been persistent, and how do we start tackling and changing them? How do we start changing the perceptions people have towards women as financial agents? And so that work is still required in my view. And a lot of it, you asked about what the incentive for financial service providers is and issues around measurement, because what has often happened is, for a financial service provider, their units of measurement are how many people they're serving and whether those people are men or women. Sometimes they might be interested in that, sometimes not. But they're also interested in repayment. Are the loans that we are giving being repaid? But the bigger question for them should also be, are our financial products making a difference to people's lives? Because if that question changes from just how many people are we giving these services to and are they being able to pay back, to then start asking, is it changing our clients? What's the point of financial inclusion? And if you have more financial service providers asking that question, then they start going beyond whether people are repaying to actually whether people's lives are changing. Then the issues of norms and how financial inclusion translates to people's well-being become important. But the key issue is, and I want to speak to the role of partnerships, because a financial service provider themselves might not be able to get to that point. And these partnerships that they can form with civil society organizations, whose fundamental question actually is whether people's lives are improving, and how that information then feeds back to financial service providers, I think is going to be very, very critical. We have a cohort of 3 projects, and one of the projects that's here in Kenya is actually just getting to the issue of measurement in terms of what do women consider successful financial inclusion. And it's coming up with very interesting indicators that even some of us would not have thought about. Some very quantitative ones, but also some very qualitative ones. That financial inclusion for me as a woman means that I'm able to use my loan in ways that I can determine. Or successful financial inclusion for me means that my business is able to grow. Financial inclusion for me means that my family lives a better life. And that then becomes an interest even for financial service providers in the sense of, are we making people's lives better? Are we making women's lives better or not? The second thing I want to say is, we know norms take time to change. And we have to be able to celebrate the quick wins. You know, that collective group of women that's changing perceptions about women's mobility or women's participation in a market because they've been able to challenge a norm as a group. You know, that changing of how staff of a bank, their perceptions about women, that a woman can enter and talk about a business without necessarily having to bring along their husband or to get permission, like that a businesswoman is a businesswoman in her own right. So there's also some of those quick wins that we need to be looking at. There's, I don't know what to call it, but there's non-conformity, and people's recognition of that non-conformity can be a very big measure. So you can also, you can track changes in attitudes of people that are actually a gradual pathway towards changes in norms, because we still recognize that a complete change in norm requires you to get to a tipping point where the whole societal perception changes. But before you get to that tipping point, what are some of the things we need to start seeing?
So there's a subjectivity to this topic of how we measure it and what does change look like. And there's also this, I don't know, I would imagine that maybe many financial service providers would like to think that the products and services they offer are making the customers' lives better. I want to give the benefit of the doubt to any providers listening. But clearly what exists in the market isn't enough, based on what Leora can point to with the fintechs data and the consistent and persistent gender gap in account ownership, and of course the persistent gender gap in mobile phone ownership as financial services become more digitized. That's a barrier and a problem. So how do we get financial service providers to think more critically and really ask this question of themselves? Are we making our customers' lives better? How do we incentivize that reflection? And in addition to that, to how do we get them to see that they are already taking norms into account in the work that they do, the delivery channels chosen, the interest rate that they picked, the gender of the agent or the frontline staffer, the risk assessment model that they use. They're already incorporating norms and they might not be aware of it. And how do we get them to be aware and then shift and change the way that their business is run? Is that a policy and regulatory level shift? And what are the network actors that are involved in that shift?
Yes, I mean, I can reflect on the policy work that we carried out with India's National Bank for Agriculture and Rural Development, NABARD, which is essentially the regulator of India's microfinance sector. This whole thing about how do you make service providers think about women? How do you make them put women at the forefront of what they're doing or right in the center of what they're doing is a very important question. When we started our engagement with them, and we were lucky because, some of them wanted to listen to what we had to say. I presented my research, which essentially demonstrated that 80% of women's loans are transferable within the household. It's only a small minority of women who get to use their loans on furthering their own livelihoods. And these women do experience benefits, but the 80% of the women whose loans are lost to the household on various things, on enhancing their husband's assets or in household consumption needs, they actually face detrimental consequences from microfinance because of repayment burdens. So, the centrality of how important livelihoods are to women's welfare, when we presented this research for them, it sort of shook something. And when we started looking at their forms, even just simple forms that they took, that women had to fill in when they actually first took credit and started opening a bank account, the form that we were looking at was 23 pages long. And in these 23 pages, the word repayment was mentioned 29 times, but not a single time were the words loan use or livelihoods ever used. So there was absolutely no link being made from loan to livelihoods, or exactly what is the purpose that you're using this loan for. They were constantly talk about, you have to make repayment on this day. You must make repayment, otherwise the repercussions of not making repayment are these are the penalties, and so on and so forth. So there is a complete lack. And then we did go ahead and work with NABARD to change the form. And now they have launched this very big digitization of microcredit groups. And in that digitization, they have included critical livelihood questions. So I think really bankers and practitioners do have their heart in the right place, but we possibly, those practitioners who are working in the field, academics who are working in this area, need to start engaging with them. And perhaps it's only imperfect information, perhaps it's asymmetric information, perhaps it's not being on the other side of the fence that's causing them not to think about, how important this whole idea of converting your loans into something useful for women, and therefore making financial inclusion work for the women, is missing out. That information gap probably needs to close, and perhaps each one of us has a responsibility in ensuring that they listen, that providers listen.
Just to add to to that comment, I remember when I've worked in the agriculture sector for many, many years. And I remember a lot of our conversations, even as recently as 5 years ago, were how financial inclusion service providers were ignoring the agriculture sector. And for Africa, that was so difficult to understand, because we kept having these conversations of how, over 60% of economically active women in the continent are in the agriculture sector. It's still the largest contributor to GDP in a lot of countries. Why then would the financial sector actually, why would financial service providers ignore such a sector? And it turned out that not a lot of agriculture people were working in the bank. So the agriculture people were actually having conversations in very different meetings and forums than the financial service providers were having. And I'm just talking to your information asymmetry comment. And it strikes me that there's an expectation that financial inclusion service providers actually know some of the gender issues that we talk about. There's a huge assumption.
Yeah.
And I don't think they all do. And I'm sure, Laura, you will have a couple of examples of some that actually understand and know these issues. And I don't want to say it's about getting a gender specialist in each one of these financial institutions. That would be a good thing, because then you have very tailor-made interventions happening with each financial institution, depending on their context and what their product portfolios are. But it's also, helping them to figure out, they know, our populations are between 49 to 52% women, knowing that out there, about half of our client base is women. And translating that to, okay, so what then do we need to do to serve this client base and to make sure that this client base is actually getting the most out of our products? And I think for them, that's a very logical, business concept. If these are our clients, we need to figure out what they need. We need to figure out what their constraints are, and we need to figure out how to address these constraints. And we just need to be able to move from them understanding this is our client base to actually using some of the evidence that we are talking about, either to then reform their processes, their products, their metrics for measurement, their engagement with other stakeholders in terms of then translating that the power of those numbers to actually benefit to those numbers, but also to products for them and processes and delivery systems that work for that client base.
Yeah, I fully agree. It's easier to encourage state-owned banks to lend to women, but to encourage especially countries which are dominated by private sector financial institutions, you have to show them that this is profitable, that they're missing half of their potential borrowing user base by excluding women from their bank. There's a nice new paper, for example, by Brock and DeHaas, where they work in Turkey with a large private bank, and they have loan officers in a lab approve or reject loan applications. And they just randomly change the name on the application to be a female versus male name. And interestingly, for example, they don't find any discrimination in terms of loan approval, but find that women are much more likely to be required to have a guarantor, right? And and digging deeper, they're showing that banks are leaving a lot of money on the table. Often women are unable to come up with a guarantor, that these are well-performing loans. And so it's greater data leads to greater transparency on the bank level for them to understand their own inherent biases. The hope is that this bank in particular makes their loan officers more aware of this bias, and they keep it in mind in making future decisions. But that applies across banks. Also, just following up on the topic of agricultural finance, this is another example where you look at women farmers across Africa, across Asia, who increasingly are selling to global supply chains. Think everything from hazelnut, coffee, cocoa, tea. We know that women are less likely to have collateral that they need for lending, less likely to have personal guarantors, but increasingly supply chains are being leveraged, right? So if you're receiving payments from a large global buyer, if that money is paid into an account, for example, on a mobile phone or a card, not only do women reap the benefits of becoming financially included, they're developing a history. They're developing a payment history where the bank, the lenders MFIs can keep track of how much they're receiving, their business performance, in order to make future responsible, appropriate loans that may not need as much as a personal collateral. So again, I think there are opportunities for banks to leverage digital payments and technology and fintech to be able to lend to women, even if they are less likely to have the collateral or guarantor.
So, I feel like you've made the case, a really strong case for why this is an opportunity missed for the existing landscape of inclusive finance and why it's important to do. I would love to just for a minute kind of think through, what if this happens? What if every provider and every policymaker decides that creating inclusive finance that's gender transformative, that really understands the needs of women, understands the customer constraints, and tries to sort of meet them where they're at, or shift and change those constraints to make life easier and access easier for female clients? What is the result? I'm thinking that culture change and normative shifts do happen, but it is very slow. It's hard to see that shift in real life. It's hard to see that in real time.
Actually, we don't need to speculate. We can actually turn to India to see the outcomes of the experiment that are actually happening right now. So it's since April 2018 that the livelihood questions in the livelihood framework became part of NABARD's digitization, which covers the entire India, so about 250 districts in India. And since then, NABARD's collated information from its partners, and it's found something quite eye-opening, I should say. The credit to livelihood linkage used to be 38%, and that has gone up quite significantly by 17%. So it's now 55%, which means that women who are financially included, who are able to access credit, are now able to use their loans to leverage to further their livelihoods. And that's gone up from 38% to 55%. Equally, banks have, private financial providers have come out to say that their operational efficiencies have gone up. So their operational costs have gone up because there is this data available on livelihoods. This enables them to recognize where markets need supporting, where training is required, livelihood training is required, and what kind of interventions are required. And all this data is in one place. So actually, and NABARD has estimated that about 270 million pounds worth of operational costs have been saved. So operational efficiencies have improved. So actually, we know what is likely to happen if financial institutions start putting women and their welfare at the center stage of the soul.
The future is now.
I'll also add that, certainly a concern around digitizing payments to women and the household dynamics is any impact on domestic violence and IPV. And so that's something that's very carefully tracked in all the studies that I've seen, and to date, there's been no evidence. However, I think there's a bigger challenge as to whether greater access to financial services can help reduce violence within the home, and that's, I guess, a future challenge.
So I want to add two comments. One is on COVID-19, and of course, one of the fears and is that it will erode even some of the gains that we know we had made on the world has made on gender equality. And we've been doing some work on what the impact of the pandemic is on unpaid care work, on gender-based violence, but also on women working in the informal sector. And because the informal sector, especially in developing countries, has really been impacted by the response to COVID-19. And the evidence we have, even from other catastrophes and other uncertainties around work, is that even when an epidemic like this happens, usually it is women assets that are first to go. And we mentioned this earlier about this distributional impact of whether it's credit or not to the family. Even within families, when there is an epidemic, when there is a catastrophe, in most cases, it's women assets that are first to go in terms of being liquidated to take care of families and so on. Women's businesses can be eroded much further when they're the only source of income to look after families. And so this is going to require a relooking of financial inclusion as well in terms of the recovery process. And we'll have to put gender and women really central in that recovery process, whether it is social protection to manage during the crisis, or whether it's economic support to rebuild and to build back better. The second one is just to reinforce what's just been said about women's leadership. That diversity is critical. Actually, the simplest way to put it is, if you needed 11 players on a team to play, why would you just put 5? Why would you just have 6 when you know that having a full team is going to get you better results? And yet, so often we are finding organizations not tap into women's potential, not tap into women's leadership capabilities. And we know that when that leadership is diverse, outcomes are also more diverse. It's more efficient, as has been mentioned, but that it's also a matter of women's human rights, because if you're not having women in your leadership, it means you are actually denying women the right to actually be at the table. So it's also a human rights issue, and we need to constantly talk about that as well.
So I can end a little more optimistically, if you'd like, that over 100 countries around the world are rushing to make COVID-related social payments, and increasingly these are being done digitally. As I mentioned earlier, cash is not as sanitary as paying into an account, and also you can avoid the physical distancing of waiting online, for example, to pick up your cash payment. So this is an opportunity. It's an opportunity to give women the financial capability, the confidence they need to potentially use these accounts and have greater say over how the money is spent in household budget decisions. There's also been an increase in e-commerce in many even lower income developing countries, which might offer, again, women greater opportunity, women who are social norms require them to work from the home, make it more difficult for them to work outside the home. Women with greater family responsibilities may be able to take advantage of some of these greater e-commerce opportunities as well.
Fantastic. This was an extremely informative discussion. Thank you so much to our three guests. To engage in this conversation and find out more about CFI's work in women's financial inclusion, as well as access links to some of the research mentioned by our guests, please visit CFI's website at thecenterforfinancialinclusion.org.